Now it's my pleasure to introduce today's keynote speaker, Professor Richard Cooper, Professor of International Economics at Harvard University. Ladies and gentlemen, please welcome him with a warm hand.
Well, first I want to thank the organizers for inviting me to this forum on an ongoing, very important topic. Perhaps I start with a autobiographical note. My relationship to the Ministry of Strategy and Finance, then just the Ministry of Finance, goes back 36 years. I first visited Korea, Seoul, in 1979 as an American official to chair sub-cabinet talks on economic issues of mutual interest. And so I've had some contact with the Ministry of Finance for a long time. And then in the 1990s, I participated in a large-scale KDI project studying the evolution of the Korean economy, both macroeconomic and structurally, during the 70s and 80s. And so I updated my knowledge and experience and contact with Koreans at that time. So I'm very pleased to be back. It is, depending on how you date the beginning of the financial crisis, it's 8 or 9 years since the financial crisis, nearly 8 years since the peak measured by the collapse of Lehman Brothers. And here we are still talking about it. And why is that? That's a long time to be talking about an event that occurred such a long time ago. I think there are two answers. One is that this financial crisis, followed by a world recession, financial crisis was focused in the United States and Europe. The recession was worldwide. Left a legacy, several legacies, which we're still living with. The first is low interest rates. Nobody, I can tell you, nobody would have guessed back in 2009 that we would still have short-term interest rates in most of the leading countries of the world still close to zero, 8 years after the Lehman Brothers crisis. So a legacy of very easy monetary policy measured in that particular way. A second legacy is much higher public debt as a result of the loss of tax revenues and, in some cases, the fiscal stimuluses that were used in 2009, 2010. In the case of the United States, federal government debt to GDP ratio more than doubled over this period of time. A third legacy, which we heard referred to already today, is a much more intense look at regulation of the financial system, and again, both at the national level, in the case of the United States, indicated by the Dodd-Frank piece of legislation, and at the international level, indicated by the work of the Financial Stability Board and the various BIS committees, the Basel committees, intense review and tightening of financial regulation of various kinds. And the fourth legacy is much more cautious by business. And here I mean, I'm talking mainly about the rich countries, business in the United States, in Europe, in Japan. We had a very nice run during the first decade of the century, Japan being a partial exception, and businesses got used to living in a world that was working very nicely and planning their investment accordingly. And so it was a big shock to have that world disrupted as it was at the end of the decade, and we're still living with the caution that business management experiences from that, or drives from that experience. So those are the concrete legacies. And I think there's another reason we're talking about it, is that there's an uneasy sense, which of course contributes to the caution, that maybe there's another shoe to drop. Maybe the financial crisis is not over yet. We've experienced one major bout back in 2008. Europe experienced a second, less serious but nonetheless attention-gathering bout in 2011, 2012, and we're not confident that that this financial system has settled back into a position of stability, even with all of the new financial regulations that we've had. Why did we have this financial crisis? As always with a historical event, the reasons are many and complex, but I want you to play a thought experiment. And the thought experiment is that there was no malfeasance and that and there was no negligence. That everyone, every participant, I mean the banks, the rating agencies, the lawyers who advised them, the regulators, everyone was doing his job in a way that was appropriate but narrowly conceived. And I would argue that the financial crisis still would have occurred. I'm not suggesting that there wasn't malfeasance or that regulators were not negligent. We have examples of both. But I am saying let us abstract from that, and my guess is the financial crisis still would have occurred. It was a system failure. And system failures can take place, especially if no one has responsibility for looking at the system as a whole, so that all of the pieces of the system can be operating in a way that each party behaving rationally and viewing his job in a narrow way, and the system can still collapse. Analogies, historical analogies are always fraught, but I would argue that the origins of World War I, in which we just experienced the centenary a few years ago, that was also a system failure. That the system that people expected to continue and operated as though it would continue, everyone else, all the other parts I can take as given and continuing to function, and yet the result of the collective behavior is that that ceases to be true, that operating assumption ceases to be true. And I want to argue, and here I'm going to focus on the United States, which I know best, and each of you can decide for your own country whether these U.S. arguments apply. But I would say that financial crises, not necessarily of the type that we actually had in 2008, but financial crises are actually an inevitable, necessary, and even desirable part of at least the American system of capitalism. And the reason, if you think through the logic of it, is relatively straightforward. Most of the public in most countries are financially unsophisticated. We need financially trustworthy institutions which the unsophisticated public can deal with. We do not trust the managers of those institutions, let's call them commercial banks, to manage their affairs without oversight, regulation of some kind. And that's the history of commercial banking, starting in England and in the continent of Europe, and then in the United States and other countries around the world. Whenever you have regulation, you have possibilities for arbitrage. And we have a lot of clever, highly paid lawyers in the United States, and we have a concept of our legal system such that anything that is not actually against the rules is permissible. And therefore, the process of arbitrage starts. The regulation creates arbitrage possibilities. The arbitrage starts working around all within the legal/regulatory framework, arguably anyway. And Initially, it's small and not greatly consequential, although it may be very lucrative for those who engage in it. But over time, more and more people engage in it, and it becomes more important. And the regulated institutions, call them commercial banks, complain that their business is being taken away from them and ask for some relief from the regulations so that they can compete with these, let's call them shadow banks, is the currently fashionable term. And so the process of arbitrage erodes the functioning of the regulated system. We could give regulators the authority to stay ahead of that process, or at least stay up with it, give them a lot of discretion, and when they see arbitrage, regulatory arbitrage, reach the point of damaging the functioning of the system as a whole, preferably before it damages it, regulators would move in, sweep in, and extend the regulations. First, at least in the American political system, we are very reluctant to give regulators the kind of authority that they would need to have in order to do that. And secondly, probably more important, the regulators themselves would have to be people of enormous courage in order to do that. Usually, there's a period of euphoria, such as we experienced in 2005, 2006. Everything is going well. As a former chairman of the Federal Reserve Bank, William McChesney Martin once said, the job of the central bank is to take away the punch bowl just as the party gets going, but in fact it takes enormous courage to do that, and the whole political system is against you. In the case of the US, both Democrats and Republicans, and the Democrats would have been led by Barney Frank, the man whose name is on the stiffened financial regulation legislation, if steps had been taken to damp the housing boom, which was occurring in mid-decade. But that's just one example. One can find many examples of that kind. So I would argue that we actually need a crisis in order to get the political support for the changes in the regulations which are necessary to adapt to the new regulatory arbitrage that has taken place over the preceding 5 to 10 years. And that's an ongoing process unless we live in a stationary state of some kind, which will not happen in the lifetime of anyone in this room. There's a constant dynamic, innovation takes place, regulatory arbitrage takes place, and we have to stay ahead of it. So in that sense, financial crises are actually necessary, and I would argue, although this is playing with words, desirable. And the challenge to policymakers is not to prevent financial crises, but to limit their damage to the real economy. And that's where policymakers failed so badly in 2007 and 2008. My own view is that they actually did an excellent job of recovering, of responding to the crisis, but only after the damage had been done and not before, as should have been the case. As you can imagine, there are many, many books that have come out on the financial crisis, various aspects of it. Some of them are memoirs of participants. Others are critical observations about what this particular branch of government or that particular part of the private sector did. I want to draw your attention to 3 books that I've become aware of, which I've found each in a somewhat different way fascinating. One is a new book, just out I think this month or maybe last month, by Sebastian Mallaby, which is a biography of I would call it an analytical biography of Alan Greenspan, the man who knew everything, or the man who knows, I guess is what it's called. And he goes through, it's a long book, 700 pages, he goes through in some detail the thinking and pronouncements of Alan Greenspan during the period of this euphoria that I talked about. He was the chairman of the Federal Reserve board from 1987 until just before the crisis broke. And why didn't he do something about it? Is the question that Malaby poses in this part of the book. There are some other parts of the book on Greenspan's earlier career. And the simple answer is that he thought the principal job of the Federal Reserve was to fight inflation, to stabilize prices. And he did not want to compromise that role of the Fed. And in fact, if you look at the record, the Fed did quite a good job of fighting inflation during this period of time. But the point is that central banks have responsibility that go well beyond just stabilizing prices. And that's something for all of us to ponder, whether we haven't elevated price stability relative to all other public objectives much too high. And we need a more complicated view of the world and a more complicated view of how we frame our objectives. Alan Greenspan is no dummy. He's very intelligent, and probably there was no one who knew the American economy better than he did. He was aware of the dangers, but he also carried a certain amount of ideological background, modified libertarianism, I would say, modified by his own experience. He was quite pragmatic. And to introduce as a co-objective to the central bank maintaining financial stability complicated greatly about how one thinks central banks should operate. And so this is an object lesson which resulted, I certainly don't want to put all of the responsibility on Alan Greenspan for the financial crisis. That would be a huge mistake. But he, more than any other single person, apart from his boss, President Bush, who actually wasn't his boss, but the head of the American government, could have done something at least to mitigate it. And that's brought out very nicely in Malaby's new book. The other two books are by British economists. One is John Kay. Some of you may know him. He's a regular columnist in the Financial Times, although he also teaches economics at the London School of Economics. And he published a book 2 years ago called Other People's Money. And in that book, he argues that every modern economy needs a well-functioning financial system. It performs 4 essential functions for a modern economy. I won't review them in detail. His judgment is that the financial system in today's modern economies, and he was talking mainly about the UK and the US with side comments on continental Europe, and each of you will have to judge to what extent his generalizations apply to other countries. But his main observation is that financial systems in modern economies are much too large to perform, much larger than necessary to perform those 4 critical functions, and they perform those 4 critical functions very badly. That they've become absorbed with trading. Trading has become the dominant characteristic and mindset of the modern financial system, and the trading has gotten out of hand and detracted. First, if it's done well, it's lucrative, so it's attracted a lot of resources into the sector, which are unnecessary to perform those fundamental functions. And secondly, it has detracted from performing those fundamental sections badly. He makes one suggestion, which I will throw out. He makes many suggestions, but one which I found particularly interesting, which is how do you hold people in the financial sector responsible for the consequences of actions by institutions in the financial sector, even when they are not individually responsible for the malfeasant action in question. And he makes an analogy to the Royal Navy, which I find quite interesting, which is that in the Royal Navy, and the same is true of the US Navy, and for all I know, many other navies in the world. If it happens on your watch, this is on a ship, you are responsible. If you are the officer of the day, you are responsible for anything that happens on your watch. If the helmsman runs onto a sandbar, you're responsible. And of course, you don't get thrown in jail, you don't get fined, but your Navy career is finished. Your Navy career is finished if something bad happens on your watch. And I think what we need, and again, I'm talking mainly from an Anglo-Saxon background, other countries are different in their legal systems, but we need some form of penalty focused on individuals now, not institutions, but focused on individuals, which falls between guilty of a criminal act on the one hand and innocence on the other. And that's where this Navy analogy becomes interesting, which is if it happens on your watch, you're responsible, and you won't be thrown in jail, but it can affect your career adversely. And I think that one of the things which, as far as I know, is not on the agenda of folks like us who think about the international financial system is how to make individuals responsible for developments that occur when they're in positions of responsibility and hold them accountable to that in some way. The third book I want to mention is by another English economist who happened, not incidentally, to have been governor of the Bank of England during the financial crisis, Mervyn King. And he published a most interesting book about 3 or 4 months ago called The End of Alchemy. It is not a typical memoir about his experience as governor of the Bank of England during this horrendous period from the point of view of somebody in that position, but it is reflections on the financial system coming out of this experience and, of course, his long career of teaching and writing about monetary economics. And his conclusion, I'm simplifying, these books are actually much more nuanced and subtle than I'm letting on, but his conclusion is that the contemporary business model of banks is deeply flawed and not sustainable in the long run in a world of what he calls radical uncertainty, that is to say a world of dynamic technical change and dynamic economies, and a world in which events in one country, which are not easily foreseen, affect other countries very much. And he ponders on this non-viability of the contemporary business model of banks, the model of universal banking, which spread from continental Europe and to Japan, to Britain, and then in the last 15 years to the United States. And he explains why he thinks it's not viable. And then he gives his solution to it, which is that the bottom line is that banks are in the position of transforming maturity. That's what they do. They accept deposits or short-term liabilities, and they lend at longer term. That works fine as long as everything's working fine, but there are periods, and we saw them in the fall of 2008, in which liquidity simply dries up in many markets. The only institution that can provide liquidity is the central bank, and therefore commercial banks should contract with the central bank ahead of time, in normal times, for what in classical central banking is called rediscounting, collateralized loans from the central bank, but at normal prices for the collateralized assets, and in normal times when markets are functioning, have a written contract ahead of time whereby counting this collateralized line of credit, think of it that way, the assets of all banks, of all deposit-taking banks, are equal to or exceed the liabilities of all deposit-taking banks. That's a very strong liquidity rule with an institutional framework to back it up, and turn all other financial activities to other financial institutions where people are investing their own money or the money of people who presumably are a sophisticated financial public rather than an unsophisticated financial public. Well, I mention these three books because they are, in different ways, all on the topic of this conference. They, each in its own way, very different, is actually a quite radical treatment of the topic of our conference. And therefore, I thought there was something that I find them all interesting, and I think many of you would find them interesting as well. And with that, I should conclude my observations, since my time is just short of being up. But I do want to mention one other cloud on the potential cloud, I guess I should call it, on the horizon. My Harvard colleague, Larry Summers, has raised the question about whether we have entered a period of secular stagnation. That is a term which actually goes back to the late 30s, and another much older Harvard economist, Alfred Hansen. I won't go into the history of ideas on this. And there are, Robert Gordon has recently written a book just about the US economy, I have to say, remind you, because his argument does not apply to many other economies, why, in his judgment, the growth of the next few decades is going to be markedly slower than the growth of the last half century. It is basically a supply-side argument, and I don't want to go into that now. That involves a lot of technical details. Summers emphasizes more the demand side. The observation, which Keynes made already 70 years ago, that in a modern economy, decisions to save, with some exceptions, decisions to save are made by different people and with different motivations than decisions to invest are. And yet, after the fact, savings have to equal investment for the economy to balance out. What reconciles savings and investment in the typical textbook these days? It's the interest rate. I've always been skeptical of that argument, but that's neither here nor there. The interest rate cannot play that function if it is close to zero. And that's the zero lower bound problem. As it is, it's not it's close to zero in major economies, even negative in a few economies, and very low even in many developing economies. So the interest rate conceptually cannot close the system if it ever could in today's world. And so we have the question of what does close the system, and the answer, I think, is the level of economic activity. So we could have the world economy functioning at a level of economic activity below its potential because savers, with their diverse reasons for saving, and changing demography is one of many such reasons, want to save more than investors want to invest. And the variable that closes the system is the level of economic activity. And if we are, I am agnostic on the question Summers has raised. I think it depends very much on Europe, whether Europe's recovery now, which seems to be real, although a little bit fragile, whether it turns out to be more like the United States recovery since 2009, slow and steady, or whether it turns out to be more like Japan, which is essentially close to zero, with some ups and downs, but close to zero. If it's the second of those, I think I will swing over to Summers' side and say we are in a period of secular stagnation. If that is the case, that's going to greatly complicate the task of maintaining financial stability, and we need to think about much more actively about how we, and I mean we, the world, in this case, because this is a global issue, how we, the world, what policy instruments we can engage in order to avoid such a period of secular stagnation. But that's the topic of another lecture. Thank you very much.
thank you, Professor Cooper, for the inspirational speech. That brings us to the close of the opening ceremony. Before we begin the first session, we will take a 15-minute recess. Coffee will be served in the lobby. Please enjoy and return to your seats by 10:30. Thank you.